The one thing I get the most hate for is that my strategy is very simple. I don't use any complicated Wyckoff schematics. I don't use 1,000 different ICT concepts, and to be honest, I just find that this is completely unnecessary. Trading should be very simple, and that is what my strategy basically involves. And now you may be thinking that you've all heard the statistic, right? Only 5% of people ever consistently make money in trading. So that leads most people to have the misconception that they must be using a rocket science level, very complicated strategy, right? But this is completely wrong. You see, trading works the best when you keep things incredibly simple and you don't have 1,000 different confluences and things to think about. So in today's video, I'm going to be giving away the full simple system that I use to secure payouts such as this one, and also to make 3% per month on a consistent basis, which is around $3,000 or so. I'm going to be giving away everything from the full trading plan, the risk management plan, where to set SL, where to put TP, literally everything you guys need to know. I'm also going to be showing you a few key processes that I use, which I rarely see talked about in the trading industry. So make sure to stay tuned for that. And without further ado, let's jump right into the video. Alright guys, so welcome to the video. First things first, let's walk through the actual technical aspect of the strategy before we go into more details about the risk management and some of the more nuanced parts of the system as well. So first of all, and step one, what we're simply doing is we're going to identify market structure and direction on daily and 4 hour. Now, in order to show you and explain this system the best, I'm going to go over to the charts and we're going to go through a live example. So if we go over to TradingView right here, and by the way, gold is the pair that I found to be the most profitable when trading the system. It's my favorite pair to trade and is the one that I've made the most money on throughout my 5 years of trading now. So as I said, step one, identifying daily and 4 hour direction and market structure. So here we can see price has come down, grabbed some previous lows, and then has broken structure right here. So this is our current bullish leg on both the daily and the 4 hour time frame. The structure in this case is exactly the same on the 4 hour, so I'm not going to go ahead and mark that on. But as you guys can see, this is the current bullish leg of this overall uptrend that we're looking at. And the point here is that because we're overall in this bullish trend and because price has retraced into a discount, we are now looking for some buying opportunities, and I'm not really interested in trying to sell price. So heading over to step two in the trading plan is basically just to identify some of the more refined structure on both the 4 hour and the 1 hour, and also something I call here drawing on previous mitigations, which essentially means, for example, right here you can see a good example of that, which is that if price comes up into an area of supply, right, and reacts from it, we're essentially boxing that off and drawing it onto the charts so that we can more easily gauge where our trading range is and where we can see, okay, so where are we looking for the shorts, right? This just basically makes that whole process a lot more streamlined and easier to follow. So here, if we jump over to the 4 hour chart, you can see that once price came down, and this is what I talk about when identifying some of the more refined zones, you can see that price has come down, taken out some previous lows and reacted from demand. This part is key because this is the indication that this could be the formation of the higher low, where price is going to bottom out and then eventually form a new high as price is in an uptrend. So this is the likely thing that's going to happen. Now, if we jump over to the 1 hour, what we can see here as well, and this is crucial, is that prior to coming into this demand zone, price was in this overall bearish trend, right? It was printing these lower lows and lower highs, and now it has created a higher high. This is the crucial and fundamental part. So what we want to do here is basically mark this on the chart, and this, for anybody that doesn't know, is called a change of character. So just a brief explanation of this. So in an uptrend, right, you have higher highs and higher lows like this. Pretty simple stuff, and we basically use the term breaker structure for when price breaks above the most recent high, leading into a new high. It's the same thing in a downtrend, except the breaker structure comes when price breaks the most recent low before the pullback, right? Very simple stuff. A change of character, on the other hand, is very simply when price breaks structure opposite to the direction of the trend. So in this case, in an uptrend, it's when price breaks below the most recent higher low. This is our change of character. In a downtrend, it's when price breaks above the most recent lower high. So like this, very simple, right? So here we can see price was printing lower lows and lower highs. It then created a higher high, therefore this is our change of character. Now, if we go back over to the 4-hour chart, and this is where step 2 comes into the trading plan, which is to identify your actual points of interest, which is where you are going to actually look for a potential buy or sell position. In this case, obviously we're looking for buys because price was overall bullish. So what we want to do is identify a valid point of interest. Now, what exactly is a valid point of interest? Well, I have 2 main points of interest. The first one is an area of supply or demand. Obviously, if price is bullish, we're looking at the demand zones within the current bullish leg of the trend, which we just identified on the daily chart. And it also needs to create imbalance, and it also needs to have some liquidity above it. Those are the main criteria that I'm using for the areas of supply and demand. And by the way, you can find this trading plan completely for free in the description below as well, for you guys to save and download and read over in your free time after this video. So here we can see, once we've identified this current hourly bullish leg, after it gave us that change of character, if we just go ahead and delete some of this as well. So after we see this happen, we're looking for any areas of imbalanced demand for price to pull back into. In this case, we have this area right here. So now on the charts, what I would be waiting for, and if I was looking at this live, I would be waiting for price to come down into this area and start to give us a reaction. Now, here is the crucial part though. We're not just gonna blindly buy or sell from this area. We're not just gonna set a limit on it. And this is where step 3 comes into the system, which is to wait for lower time frame confirmation entries. And this is going to give you an optimal risk to reward on the trade so that you can be, wrong 70% of the time and you can still make money. It's a massive game changer in your trading. So in terms of step 3 of the trading plan, if we go down to here, I've included a few more nuanced details here, but I'll let you guys read through that in your spare time if you download the trading plan in the description. Again, completely for free. Now, once price is tapped into our point of interest, right, this is when we're going down to the lower time frames, and in particular, this is important, I'm only using the M5 time frame for the entries. I'm not using any other time frames. This just leads to confusion. I used to do this and it just led me to being confused and not really knowing exactly when to enter. So as of right now, we're going to the M5 time frame to identify current lower time frame structure, right? So if we go head over to the charts, I'll show you exactly what I mean by this. So now that price is in our point of interest, right? This is when we're hopping over to the M5 chart, and all we want to see, because we're looking for buys, we want to see price flip back bullish on this lower time frame, on the M5 time frame. Now, in order to do that, we're again looking at lower time frame structure. So notice how price comes down, lower lows, lower highs, typical bearish price action, right? Once it comes into this demand, we're waiting for it to break above and close above the most recent lower high. In this case, we can see this area right here. So far, very simple stuff. Once we see this happen and once we see this change of character, we're then looking for an area of imbalanced demand on the M5 time frame for price to pull back into. In this case, we can see we have this one right here. This whole area, that's where the volume came into the market. So this is your demand. Notice as well how we have an inducement just above it. That's not necessary, but in this case, it's just an extra nice confluence that will slightly increase the probability of the trade playing out. So once we see this, as I said, very simple stuff. We're just setting a limit on this area with a mechanical 1 to 3 TP rule. And again, this is a massive game changer if you guys haven't come across it before, but using this mechanical TP takes all of the head out and complexities in your trading. For example, if you didn't use this mechanical TP rule, you could target, this high, this high, this high. You don't know where to target, right? So just having this 1 to 3 mechanical TP rule, which by the way, I've optimized according to several years worth of data. This is the best risk to reward to use and gives you the best combination of risk to reward and win rate so that you don't, go on tilt and it doesn't affect you psychologically that much. So that's essentially it. We're setting a limit on this area, mechanical TP rule, and we're looking to position our stop loss just below the low every single trade. It's exactly the same thing, right? Very simple stuff. And in this case, you guys can see the trade eventually does come back down, tags us in after creating some more liquidity above the demand, and then eventually heads over to TP, right? as you guys can see right here. So let's go through another example before we head into the risk management plan. So now that we've seen price make its way over to the upside, right, we can still see that it's overall bullish, right? So if we just play price on a little bit more, and this is the next trade that I was looking at, notice how price is now pushed up, we're still bullish, and it hasn't yet taken out the high right here. So what we've got to ask ourselves here is, based on what we're looking at to the left, based on where price is trading to the left, and based on the fact that it's just at this random resistance, right, and it's building all of these highs right here, what is the probability that this reverses and goes back to the lows versus continues to the upside? In this case, it's much more likely, right, that price heads up to at least take out these highs before any sells come into play. So what I'm looking for here, and this is the next point of interest type that I wanted to mention, is a previous area of liquidity. In this case, we can see we have this area right here. It's a clear area of liquidity because it's this previous low that led into this imbalance. So this is obviously an area where people were buying price, which caused this push up in the market. So now that we have our bias, which is bullish, now that we have our point of interest, we're simply waiting for price to pull back into this area. And once again, once that happens, we jump over to the M5 time frame, and we're simply looking for price to give us that change of character once again. So if we zoom in right here, we can see if we play price on a little bit more, we can see that it eventually does close above the most recent lower high, which was this one right here. It creates an area of imbalanced demand right here. Again, some inducement above it, which is what we like to see. So at this point, we just set a limit on this area. Stops below the low, like I mentioned before, and mechanical 1 to 3 TP rule once again. And as you guys can see, in this case, the trade does play out very nicely. And I'll be honest, obviously, this is going to work every single time. The strategy on average for me has around a 45 to 50% win rate, but with a 1 to 3 risk to reward, obviously this is going to get you some crazy results, and it's also just a very simple headache-free system that you guys can incorporate. Now, there is one final thing to mention about this strategy, which is the actual risk management side of things, which, to be honest, is the simplest and easiest part of the entire system. This is purely mechanical, there's no discretion whatsoever, and you guys can simply rinse and repeat this on every single trade. There's no reason to stray away from the rules, and you guys can just simply follow this every single time mechanically. So what I want to mention here, right, if we go over to the risk management plan, is first of all, what percentage risk are we doing? For me personally, this is 1% risk per trade. This is the best approach I've found, which both helps you to limit tilt, by meaning that if you go on a losing streak, for example, which is inevitable with any strategy, if you do go on that losing streak, it's not going to affect you too much psychologically, and you're going to be able to weather that storm and not go into too deep a drawdown on your account. Now, this is also incredibly important, right? So the risk must stay the same no matter how I personally feel about the trade. So let's say, for example, I see a trade and I think, oh, this trade doesn't look good, it looks like a bad quality trade. Well, that thought, right, my subjective view on that trade, whether it looks good or bad, does not determine whether it's going to be a win or a loss. That is to say, if the trade looks like a bad trade, it may still be the winner in a sample of 10 trades. So the key right here is to take all of the trades you see rather than to filter out the good and the bad looking trades, because that way you keep your probability edge and you allow the sample of trades to play out. If you, for example, only take the trades which look good, and let's say you take 10 of them, all 10 of those may be the losses, and the bad trades may have been the ones in the sample that would have been the winners. So you've massively skewed that probability edge and negatively impacted your trading. So risk stays the same no matter how I feel. I don't make break even, no partial take-in. As I said, this is based on over 5 years worth of live data and also several more years worth of back-tested data. I found that making break even or taking partials actually makes it less profitable rather than just using that 1 to 3 mechanical set and forget approach. And that is literally it, guys. That's the whole risk management plan. That's the full trading system. And as I mentioned, very, very simple stuff. and that is exactly how trading should be. Now guys, I mentioned at the start of the video that I'm going to be talking about one of the key processes which has consistently allowed me to improve my trading over the past 5 years. Now, I rarely hear this talked about in the trading space, but if you stick around, I guarantee this is going to be a game changer for your trading. Now, the process that I'm talking about, I'm referring to, is something called ASR. What does ASR stand for? ASR is called Advanced Self-Review. It's an acronym for that. So what does this precisely mean? So ASR is essentially a performance review that you do every single week and at the end of every single month. I also do it at the end of every single quarter as well, so every 3-month period. Now, if we take a look here, I've got my Notion template for this up. I'm also going to leave this template for free in the description below as well, so you guys can download it. But essentially what we're looking at, right, is if we go into one of these, so you've got these weeks and you've got the months, right? If we're doing a weekly ASR, what this basically means, if we go into week 1, for example, and if we get rid of this, so what I'm basically including here is the number of wins and losses that I have during that week. That's fairly obvious and quite familiar to you guys, I hope. Total trades taken and total percentage return. Here is the key though. What we want to include here is not only the trades that we took, we also want to include any trades that we missed. And for me, this is the most important part because this is where I'm going to see, okay, so my strategy is making X% of profit per month. For me, it's an average of 3%. How can I improve that? Well, I improve that by taking any of the trades that I missed, which were valid setups, but which could have made me that extra, I don't know, 3, 4, 5%, right? So if we go into this section right here, you've got the full template once again, where we're writing down, obviously, the profit and loss of the missed trade. We also want to include some screenshots of the trade, so we have a visual reminder of what the winning and good trades look like. We also want to include the technical aspect of the trade itself. So why did we take it? What were the confluences? Obviously, this is going to be very similar every single time, but in this section, I'll just basically tell the story behind the trade, the overall narrative, and my thought process at the time. Psychologically wise, obviously, because it's a missed trade, there's not going to be any emotions involved, but what I include here is the potential reasoning behind why I missed the trade. So it could be, you know, it was Asian session. That's a fairly common reason for a missed trade, but it could also be reasons such as fear of entry. I saw the trade, but got fear of entry, so didn't take it, or I overthought the trade, all of these sorts of things. But journaling these down just allows you that sort of clear and concise way to look back so that you can see, okay, what am I doing wrong on a consistent basis? How can I improve this going forward? And this is going to be a massive game changer to helping you improve in your trading. So that's how I would basically journal the missed trades. And then obviously for the actual trades taken, it's very much the same thing, but just very importantly, including some screenshots of the trade so that I have a visual reminder of what winning and losing trades look like. So guys, it's literally that simple. I literally show up for around 10 minutes each day, do my morning analysis, set alerts at my points of interest, and then just simply go about my day. Once price comes into the point of interest, I'll monitor for an entry. But apart from that, that's how simple trading should be, right? You don't need complicated Wyckoff schematics or rocket science level theory or 1,000 different ICT concepts, right? You just need this simple process that you can repeat every single time you come to the charts. Now, of course, you may not understand the ins and outs of the strategy, and if that is the case, I would like to invite you into VIP. You can check that out in the description below. It's the full course on how I trade. I do daily live calls in there. We have live backtesting, we have a community, we have the full training plan, everything you guys possibly need. So check that out in the description below. Now, if you guys also want to see how this strategy performed over around a year's worth of backtested data, then I would recommend watching the gold backtesting series next. And you guys can watch that by clicking on this video right here. But thank you guys for watching, and I will see you in the next video.